You ever look at a company's financial report and just your eyes glaze over? It feels like you're staring at a wall of pure numbers, right? Well, today we're going to crack that code. We're going to take one company, APA Corporation, and figure out how to find the real story hiding inside all that data. Okay, let's get into it. And there it is, the wall of data. I mean, look at it. P ratios, ROE, debt to equity, dozens of different metrics. At first glance, this is completely overwhelming. Is this company a winner? Is it a risky bet? It's pretty much impossible to tell just by staring at this. It's just noise. So that really is the million-dollar question, isn't it? How do we turn this mountain of data into a clear, simple story that we can actually understand? How do you find the signal in all this noise? Well, turns out you don't need a PhD in finance. You just need a good plan. And here is our plan of attack. We're going to use a simple checklist to ask 3 really important questions. Is the business profitable? How stable is it, really? And what's a fair price to pay for it? Then we'll put all those clues together and see what the big picture looks like. We're calling this the Value Investors Checklist. It's a simplified framework, kind of inspired by legendary investors like Warren Buffett. His whole philosophy is about finding wonderful companies at a fair price. And this checklist, it's designed to help us do just that, cut through the clutter and focus on what truly matters. So these are our 3 big questions. They seem simple, I know, but trust me, they are incredibly powerful. By answering each one using the data we have for APA Corp, we can start to piece together a surprisingly clear story about the company. First up, profitability. Because let's be honest, a company that isn't making money isn't really a business. It's more like an expensive hobby. And one of the best tools we have to measure profitability is a little metric called return on equity, or ROE for short. So what exactly is ROE? Put simply, it tells you how good the company's management is at turning investors' money into actual profits. For every dollar of shareholder money they have, how many cents of profit can they squeeze out? A higher number is almost always better. It's a fantastic measure of efficiency. And APA Corp's current return on equity is 23.54%. Now, for context, anything over, say, 15 to 20% is usually considered really, really strong. So on the surface, that number looks fantastic. But is it the whole story? And this is why context is everything. Whoa. Okay, so while that current 23% is solid, look at the average over the last 3 years, a mind-boggling 160%. Numbers like that are not sustainable. They just scream volatility. It tells us that, yeah, the company is profitable now, but its earnings have been on an absolute roller coaster. So for question 1, it's a yes, but a very shaky yes. That wild ride with profitability leads us right to the second question on our checklist. How stable is the company? A profitable business can still go completely belly up if it's drowning in debt. So we've got to pop the hood and look at the balance sheet. And our go-to metric here is the debt-to-equity ratio. It does exactly what it sounds like. It compares all the company's debt to the total amount of shareholder equity. A ratio of 1 means for every dollar of equity, there's a dollar of debt. The higher that ratio gets, the more financial risk the company's taking on. Okay, so APA's current debt-to-equity ratio is 0.74. That means it has less debt than equity, which is generally a pretty healthy sign. But as we just learned, a single number without context can be misleading. And wow, this chart tells a heck of a story. Just look at that difference. The current ratio is a healthy 0.74, but the 3-year average was all the way up at 3.83. This tells us that management has made a massive, deliberate effort to pay down its debt and make the company much, much stronger. This company is way more stable today than it has been in its recent past. That is a big, confident checkmark for stability. All right, so we've established the company is profitable, though it's been a wild ride, and it's become a lot more stable. Now we get to the final and maybe most important question on our checklist. Is the stock selling for a fair price? Because remember, even the greatest company in the world is a bad investment if you overpay for it. So here's the side-by-side. On the left, you've got the market price, $38.06. That's the price you'd pay for a share on the stock market today. But on the right, we have an estimated fair value price of $34.29. Now that's an estimate of what the company is intrinsically worth based on things like its future cash flows. As you can see, the market's asking price is a little higher than what the models say it's worth. This brings us to a really core idea in value investing, the margin of safety. It's basically the discount you get when you buy a stock for less than what you think it's actually worth. Think of it as a financial cushion. If your estimates are a little off or the market takes a turn, that margin of safety is what protects you from taking a big hit. For APA Corp, based on this data, the margin of safety is negative 11%. This just puts a number on what we saw on the last slide. It means the stock is currently trading at an 11% premium to its calculated fair value. So according to this model, there's no safety cushion. In fact, you'd be paying extra. Okay, so we've asked our 3 questions. We've gathered all the clues from profitability, stability, and price. Now it's time to step back, put all the pieces of the puzzle together, and read the full story that these numbers are telling us. So here's the rundown. First, profitability is looking strong right now, but its recent history has been a roller coaster, which suggests a certain level of risk. Second, the company has done a fantastic job of becoming more financially stable by tackling its debt head on. That's a huge positive. And third, despite those improvements, the stock's price seems to be a little ahead of itself, trading at a premium to its estimated fair value. So, as you can see, it's not a simple story of good or bad. It's a much more interesting story about a company in the middle of a turnaround. A company that has massively improved its stability, but still deals with volatile profits, all while the market seems to have already priced in that success. The goal here wasn't to give you an answer, but to give you a framework to find the narrative for yourself. So, looking at these facts, what story do you see?